Today, we're going to discuss wealth hacks. So, ways that you can stop making the tax man and maybe even the health insurance company rich at your own expense and start building lasting wealth. So, here's a few of the things that we're going to cover. As an example, are you getting killed in capital gains taxes? Are you trading your Magnificent Seven or whatever hot stock, Tesla, whatever you think is hot? Are you trading that in a regular account, or are you doing it in your broker sponsored retirement accounts? Also, same with crypto. Now that we have some ETFs, you can actually trade crypto in a retirement account. Are you doing that? Are you taking advantage of that? Or are you giving up maybe 30% or more in capital gains when you capitalize on, some of the gains that you might have? Also, are you aware of the power of seven? Have you looked at the return rate on your annuity? I just looked at one and it was 2% for somebody. Are you aware of the benefits of the health savings account, which offers a tax credit so that you pay less to the tax man and you pay less to the health insurance company? Of course, this is for Americans, not Canadians. Do you even know what's in your 401k or RSP? I might have already said that, but it's really important. And should you chase things when they hit the all-time high, as Bitcoin and stocks are doing today? All this and more in today's video conference. Remember, you can watch it back live. You can watch it live with us. Just email info@nataliepace.com so you can join us live next time. Put VideoCon in the subject line. Also, share this with your friends. It's absolutely free and it's a game changer. Once we set up our financial house, we can live inside and we're protected from economic storms. We can have a great life and a lot more money to play with when we stop making everybody else rich. So we get started in just a moment. Okay, so the first thing I want to show you is that you can actually check all of this out in my new blog. All right, and this is easiest to go to just nataliepace.com/blog. Of course, if you're coming back in a couple weeks, it's going to be a new blog there. So email info@nataliepace.com if you want a link to this exact blog about wealth hacks. So here we go. And these are some of the things that we're going to be talking about, right? So we just said, hey, we want you to ask yourself these questions. Are you putting your hottest investments in your Roth IRA? So that's what you want to think about your nest egg. This is all your liquid assets. So you're going to have that employer sponsored plan. You might have a Roth IRA. You might have a checking account, a savings account. You might have a credit union. You might have certificates of deposit or treasury bills. And it's the thing is, where should you hold these things, right? So I say this, look, the employer sponsored plan has limitation on what you can invest in. But the benefit of it is that they will oftentimes match your contribution. That's free money. So you want to take it. But I would suggest that you think about taking it up to the match for the free money and then start thinking about these other accounts. So you might think about a Roth IRA where you could actually no capital gains taxes, you have freedom of choice. And once you start taking it out when you retire, then you're not going to pay any capital gains taxes on it. So that's the benefit of having that. So again, your nest egg is actually going to be made up of a number of different accounts, not just one. Your employer-sponsored account where you don't have that freedom of choice, maybe an individual retirement account, or in Canada, a TFSA, where you do have freedom of choice and you don't pay capital gains, and sometimes you might not even pay taxes when you withdraw it. So all of these things, you might think about them. Now, in the United States, but not Canada, we also have another one, and that's the health savings account. So if you are healthy and spending an arm and a leg on health insurance and you're not yet qualified for Medicare, then you could actually be putting money in your own retirement account. Once you get, your total out-of-pocket costs for maybe a couple of years, you can actually start investing it. Again, the benefit, no capital gains taxes, but there's other benefits. One is that you are going to be able to get a tax credit. So then you're paying less to the tax man. And you get that higher deductible, so you're paying a lot less to the health insurance company, money that you get to keep. And then the added benefit is that it becomes the best long-term healthcare plan. So you could have, the biggest expense in retirement is healthcare costs. So a lot of people say, oh, my employer covers it for me. But what they're not really looking at is that if you looked at, the details, most of the time the employer is providing it for you, but not paying for it for you. So you need to look at the details of your W-2 and see, because you might actually be paying for it. And there might be a way that you can actually select same plan, higher deductible, with a health savings account that becomes your individual retirement account, tax credit, so you pay less in taxes too, and best long-term healthcare plan. So another tip I would say is that when you're thinking about where to invest where, of course, the employer plan is going to have limited choices. So oftentimes that's a place where you might get your large caps and maybe some of your safer investments. You might be able to get a small cap fund as well. Chances are you're not going to get a targeted ETF. So you can't target information technology or artificial intelligence or anything else that you think might be interesting in there. In a crypto, you can't do that in your employer sponsored account. Now, the other tip I will say is that a lot of people are still trading their crypto on a crypto brokerage. And if you get a crypto ETF, you're limited to two. You can only do Bitcoin or Ethereum. You can actually put that within a Roth IRA so that when you are capturing gains, you are not paying the capital gains taxes. And capturing gains, we've seen crypto winters, usually about 1 year after 1 year after the halving is usually the high, and the second year is usually the crypto winter. That has happened in the last two Bitcoin halving events. So it is a good idea to have a capture gain strategy, even on your crypto and on all of your HOTS. Now, the other thing I wanted to talk about is that annuities, I do a lot of second opinions for people. I'm doing one right now for someone, and they had no idea that when you buy your annuity, they take 9% away from you. They call it a surrender fee, and they really underperform. So this particular annuity is only doing 2% annualized. As I mentioned when I opened up this call, stocks have done over 50%, large cap stocks, the S&P 500, over 50% over the past 2 years. So you're really, really underperforming. You could even have had, a short-term treasury bond, which is pretty low risk, or even a short-term CD. And that would have given you over 4%, even up to 5% over the past couple of years. So this is really, really underperforming, in addition to it's not FDIC insured. So it's not as safe as a lot of people realize. Another thing I wanted to talk about is with stocks and Bitcoin at an all-time high, should you be buying? And the answer is if you already own it, chances are you need to capture your gains. So, what we have encouraged, and which is a time proven 21st century strategy, is that you want to always have an age appropriate, properly diversified plan. In a debt world, you need to know what's safe on the safe side, too. We spend one full day on that at our investor educational retreats. And then you need to rebalance once, twice, or three times a year. And the reason that you need to rebalance is that things will go up or things will go down. If things go up, you want to capture gains and keep that wealth. When things go down, you have that kept wealth and that liquidity, and you've limited your losses so that you can buy more at a lower price. So with things at an all-time high, this is the perfect time for most people to do a rebalancing if you haven't done it in the past year, or even the past 6 months, or if you've never done it. Now is the time to really say, okay, I want an age appropriate, properly diversified plan where I'm getting 4% safely without paper losses. And that's doable. So people who are using our safe strategies are not experiencing the paper losses, and the at-risk strategies are doing fantastic because we have been leaning into large cap growth, and that's where the Magnificent Seven is. Tech B, which is a targeted ETF, which has a lot of Magnificent Seven. Artificial intelligence, cybersecurity, and even Bitcoin and Ethereum. In 2024, Bitcoin was actually my investment of the year feature. So again, these hot slices can really outperform. And the key is instead of riding it through a roller coaster of downturns, a bear market or a recession or a crypto winter, capture gains. If you have one slice, it's become five slices, it's screaming at you. You've got too much at risk here, sell high. It's not all or nothing. Trim it back to a slice. And that way, if it keeps going up, you can capture gains again in a year. But if it goes down, like it can do in crypto winters, and your slice becomes a sliver, you've kept the wealth and you can now buy low, right? Because the 2022, Bitcoin was down to 15,000. It's 120 something right now. So, it's a really good idea to have this capture gains mentality there. Wanted to make sure people know. So, should you buy high? If you don't have large cap growth, Magnificent Seven, cybersecurity, or some of these hots, and again, I put my hots in my Roth IRA because no capital gains taxes. And when I withdraw it and, when I'm ready to retire, I don't have income taxes. A regular retirement account, no capital gains taxes, but you don't have the added benefit of that income tax, no income taxes. But if you're just trading your hots, and a lot of younger folks are, we're calling them the retail trader, right? They're not aware that you should be putting this in retirement accounts so that you avoid the capital gains taxes. This is a big deal. I wanted to make sure, so should you buy high? If you don't own it, I would just suggest dollar cost averaging and taking 2 years because the top to the bottom in stocks is typically 18 to 24 months. So instead of just buying at whatever price it is, especially if it's an all-time high, to fill up whatever slice you're missing, think about that 2 year horizon of how you want to fill up that slice. And that way, if you buy a little now and the price goes down, instead of saying, I lost all this money, you can say, oh, great, that's why I have this plan in place. I'm now going to buy more at a lower price with my next tranche. And if it goes lower, you've saved a little bit more because you have that 2 year horizon. I wanted to talk a little bit about the rule of seven. So, if you're depositing 10% of your income into tax protected retirement accounts and it earns a 10% gain, you'll have more money than you earn within 7.5 years, and your money will make more than you do within 25 years. This is the only way really out of the rat race. So it's important not just for you to know it, but also your kids and your grandkids too, if you're nearer to retirement age. So again, all of this is covered in my blog. And again, it's at nataliepace.com/blog. You're going to be able to see a lot of different things and also have links to other things that I think are pretty hot. You're also going to see that power of seven in action. You're going to see that stocks did over, what was this, over 12% annualized. Oh, this is large caps over the 30-year period. So it's not rocket science to be able to do this. Now, again, one of the biggest things to be able to, and again, you want to make sure that you know about the recessions because right now, stocks are at an all-time high, but we really haven't experienced a recession or a prolonged downturn since the bottom of the Great Recession back in March of 2009. And that has to do with a lot of financial engineering. So it's really important because look, recessions are a normal part of a business cycle. We have had an abnormal business cycle because of the pandemic and because of printing up trillions of dollars to borrow our way out of having a recession. So it's just important to understand that and to know that, because of that heightened risk and equities being at an all-time high and the outsized downturns that can happen when we have really expensive stocks, we are overweighting in our sample pie chart. So we are pretending we're a little bit older than we are. But it's never all or nothing. It's a balanced, age appropriate, properly diversified plan that's hot. And again, you can now know a little bit more about how to build lasting wealth by stop making the tax man rich. Don't give up your capital gains. Put some of these hot stocks in your Roth IRA or at least in an individual retirement account. You're not going to be able to invest in targeted HOTS in your employer-based account. And that is why you don't want to just put all your money there and not have any money going into your individual retirement account. Okay, I'm going to stop it here for a moment. We've got a couple people on, and if you guys have a question, I'll go ahead and answer your question. Of course, if it's um, something that everybody would benefit from, then I'll record the answer. Okay, so how can you learn more about this and more? Like, what do I think is hot? What do I think is a way to get that good 4% yield with no paper losses? There are many ways that you can do it. I would encourage you to start at nataliepace.com. Again, you can read my most recent blog. There's lots of links there to other resources as well. You could consider, again, if you have never rebalanced your nest egg, and especially if you're getting close to retirement, it's even, I would say, if you're 40 or over, because we have seen that in normal recessions, well, 21st century recessions, stocks dropped 55% in the Great Recession. They dropped 78%, NASDAQ stocks did in the dot-com recession. And it took 15 years for those to recover. Now, equities are almost expensive today as they were in the dot-com recession. So I would say it's pretty important to be aware of that. And now would be a very, very important time to know what you own and know exactly what you own and why, and what you might consider trimming back, capturing gains, what things might have been a good idea back in the day, but not as great of an idea going forward. Again, in the paper losses category, the simple strategy is keep the term short and the credit worthiness high. Of course, the devil is in the details. And there are some low-hanging fruit that many people should be considering. So again, we do spend one full day on what's safe at the Investor Educational Retreat. So we do that. And we're even going to host a master class on that topic on fixed income and bonds on the Saturday after the retreat. So you can get additional information on that. Just go to nataliepace.com. It's scroll down, you're going to see the retreat information. There's the retreat flyer, everything about pricing information, what you're going to learn, testimonials. One thing I do want to say is that the early bird pricing period does end on July 31st. So you're going to save hundreds of dollars if you register now for it. Also, in that early bird pricing period, you could bring a teen or a college student for just $99 with you. And you can bring a second person for half off. So it is important to look at that now. In terms of the Bond Masterclass, if you just click on the menu, you can see a listing of all of our various things, including a link to the Bond Masterclass where you can learn more about that as well. We do offer a bundling discount. Of course, you can also read about it in my best-selling books. Start with the ABCs of Money. It talks about everything that I just talked about. And if you are not already signed up, then be sure to send an email to info@nataliepace.com with VideoCon in the subject line so you can join us for our free live video conferences. We host them at least once a month and sometimes 2 or 3 times a month. Okay, thanks for joining me today, and we will definitely hope to see you in October online for the Financial Freedom Retreat and the Bond Masterclass. I'll see you next month with another investor, free video conference as well. And of course, if you have any questions, suggestions, if you would like an unbiased second opinion through my private coaching, if you have a hot tip suggestion, if you want to know more, I'm actually going to be posting on today. We got the Genius Act passed. So that's going to affect cryptocurrency, specifically stable coins. So we will be talking about that as well in a new blog. So stay tuned on that. Thanks again and have a lovely day.